Had my microphone on mute, I think, all the way through that. So I'll just do a quick recap. If you're watching the recording, it was held at 12:30 on the 20th of September. And now we're going to take a look at the markets. What an incredibly unprofessional introduction that was. Right. So the market we're looking at here, this is pound against the US dollar. So last week was a really big week for the pound because we had a whole chunk of economic data. On Tuesday we had inflation data that was coming out, and that came in at 2.9%, so above the Bank of England's target, and that left people speculating that maybe we'd see a rate rise in the UK sooner rather than later. So that was one reason we saw a lift in the pound. Then on Wednesday last week we had unemployment data, a multi-year low. Then on Thursday, the main event I think for the pound was the Bank of England, the interest rate decision. And no change as usual, but Bank of England definitely starts making noises that maybe there's going to be an interest rate sooner rather than later in the UK. So I think at the moment it seems to be nailed on. We'll have rates rise by February, possibly 2 rate rises by February, but people talking about maybe November, the first rate rise, so lifting that UK base rate off all-time lows. So you can see the effect on the pound. You know, just where are we here? From the middle of August-ish. When was that? Third week of August, trading at 128-ish pound US dollar, and currently trading at 135. You know, so a 700-point rally, just off the lows this year. We're up 1,500 points. So what's that? About a 12% rally we've seen off the pound. We'll come back to the size of this rally in a minute. But I think the reason it's interesting, you know, this trend, if you've been attending these webinars for a while, and we've been talking about this recovery trend in the pound. So it's been no secret that the pound US dollar anyway, has spent most of this year coming up. And the target it was looking for were these old highs, the sort of the post-EU referendum sell-off highs, where it had a bit of a few dead cat bounce moments, but couldn't really get through 135. And I thought, well, maybe we'll claw our way back up there, towards the end of the year. But we're here, we're here already. And it's interesting up here because this was such a big level after the referendum. You can see, just how many goes the market had at breaking this level. And then last week, bang, it just goes through it like a knife through butter, so we've hit the best levels since the day after the referendum. So what happens next? Well, that trend is still up. I have to say, I think maybe best case is chop around here. Can we really see, after gaining 1,500 points in the last month, the market putting on another 500 to 700 points in short order? I can't really see that. So maybe we'll just have, for pound US dollar, something of a getting used to it phase. Maybe we're due some chop now for pound US dollar. I mean, if it starts to sell off, it still looks like a buying opportunity. We've got this bigger trend still in place. If it did drop, famous last words, I can't see it happening, but if it did drop all the way back to 128, where it was in August, it looks like a great buying opportunity because we've got big support down here. But at the moment, I'd say, medium to longer term outlook is for further gains for the pound. We need to see if we can see, a break above last week's highs, a sustained move through 136. We can see, I don't think it's ridiculous to see a move up to 140, but maybe in the short term, after the surge the market's had, it's caught a lot of people by surprise. We'll just have a period of just sort of, sideways chop up at these levels. Someone's saying it's way overbought, and that's after a rally like that. Clearly, it is going to be overbought. Let's plonk an RSI on there, but I'd also caution that because just because a market goes overbought doesn't mean it can't go up any further. The market, if we look on our RSI, we've got a 10-day RSI. It was overbought here. It was overbought at 132, and it put on another 400 points since then. The market has been strong. So I think what would be quite handy, would be a bit of sideways here, maybe a bit of a drift, and then this unwinds itself from being overbought. But interestingly, to me anyway, on the 10-day RSI, no, that's a 14-day RSI. Let me change it back to my favorite 10-day RSI because it's 2 weeks. 10-day RSI. When was the last buy? We did have a buy signal. That nailed it pretty well down there. But the last time we had a sort of a proper buy signal where it dipped into oversold before August, we've got to go back to March. So it shows how strong the market has been this year. We'll come back to this RSI a bit later on during today. But it's a really big level that it's got to. You know, the market's put on something like 12% this year off those lows. You know, if we were trying to forecast where it's going to be in 6 months' time, and I'd be looking at maybe the early 140s. You know, while this trend stays intact, looking up at these levels up here. So that's pound US dollar. I think that really was the big currency story last week. We'll come back to this when we go on, when we look at the strategy thing today of picking tops and bottoms using RSI divergence. But for now, let's just leave things there, and we'll flip over to have a quick look at euro sterling, because the strength of the euro, particularly versus the pound, you know, with the whole Brexit debate, whether you're a leaver or a remainer, you know, I think this is, I think maybe helped fan the flames of that debate because the euro has been so strong. But I thought it's interesting where it's run out of steam again. You know, everyone was sort of raging about how strong the euro was during August, and since then the market's given up nearly 400 points. This is euro sterling, so we've seen a bit of euro weakness coming back into play. But I thought it was interesting because if you look at where it is, we did look at this, I think, last time round. You know, we've got to go back to 2008 when the euro was last at these levels against the pound, and you can see it just couldn't. 98 was the high back then. That's not very well drawn by me. Hang on a second. Let's plonk another one in there. And then we got the sort of 94 to 98 level was a real barrier for euro sterling coming off the back of the financial crisis. And you know, once again, it's proved to be something of a stumbling block. So yes, the trend for euro sterling is still up. I'd still be tempted to be a buyer on weakness of the euro versus the pound. So our trend looks, hang on, something like that. So an aggressive trade, actually. This is a weekly chart, isn't it, we're looking at? So let's flip it over to the dailies. An aggressive trade is probably to be a buyer now, if we're looking at that trend from back here. Here we go. So we're plonking our trend, something like that. So there we go. So I would say if you really wanted to trade euro sterling, we had all this sideways bit of support, quite a bit of support ahead of 87. The market's currently 88.64. So if you thought it was going to have a go and rally 500 points again, to have a look at those highs, you know, there are worse places to buy than here with a stop under where we are now, and that trend is still intact. But I would just keep an eye on the bigger picture for euro sterling. Those 9-year highs, you know, ahead of parity with the pound. I think it's maybe a bit too optimistic at the moment to be expecting the euro to end up being worth £1. But I thought it was interesting how it's moved over the last few weeks or so. Let's take a look at euro dollar. Then we'll do our strategy thing. So here's our euro against the US dollar. This is a daily chart, and again, this is another one, you know, like pound US dollar, that has had, you know, quite an incredible move this year. If we go back to April, you know, the euro was trading around about 106. It's currently trading just above 120. So we've seen a 1,400 point rise for euro dollar. And you know, I'm looking at the weekly chart here, going back a bit in time. It's still a really bullish chart. You know, just keep an eye on the bigger picture. The 2015 highs, the 2016 highs in that whole sort of 116 to 117.50 area had been quite the barrier. The market broke through in July of this year, and I think it's a market that still looks strong. You know, euro dollar. Let's plonk the old trend line on there. Fantastic chart, a fantastic trend. So if we pick that up, you know, so for now at least, here we go. So we had a bit of a sell-off just over a week ago, but once again the trend has held. The most immediate support is ahead of 118. So if we sold off a couple of hundred points from where we are now, it still looks like a buying opportunity. And I think the really big support for this trend, if you look at these levels here from July, so 116 through to sort of 116.60, that sort of area. So I think for now at least, any weakness in the euro dollar still looks like a buying opportunity. Let's see. I mean, tonight is a big event tonight in the USA. Tonight, is it 7 o'clock? Isn't it 7 o'clock or 6 o'clock? I can never remember. But I think it's no, I don't. I'm going to guess. I think it's 7 o'clock. But we've got the latest interest rate decision from the US Federal Reserve, the central bank in the States. No changes expected to interest rates, but I think, like a lot of central banks at the moment, we're expecting maybe them to make some sort of comment about reeling in some of the stimulus that we've seen for the US economy, you know, via QE and all that sort of stuff. So I think we could have a quiet afternoon in markets and then maybe some volatility off the back of that this evening. We'll see what happens. But euro-dollar trend still very strong. I'll do one more currency, then we'll jump onto strategies. Okay, so let's, the currency I was going to look at, I thought dollar yen is a good example. If we bring up the chart of dollar yen, of a false signal that didn't work out, but how the market has rallied since then. So we were looking, I think when we've looked at dollar yen this year, there's been a really obvious big level of support, and it's 108. Okay, so the 108 level, the market had sold off. There was no way of knowing it was going to be support in April, but the market rallied off 108. We saw a 600-point rally into May. Then the market came back again, dipped briefly below 109 in June, rallied. And here in August, late August, it looked like once again this 108 level was going to hold the market up. But we saw it break, and it was quite, you know, it moved, I think, about 70 points below that support. So it wasn't, you know, a little poke through, it was a decent move. But I think what was interesting was the rally the next day. So pretty quickly the next day we were back above that support line. So if I'd have bought here, I'd have been stopped out, definitely. But the fact it moved back above, you know, an aggressive trade again, if you're going to trade false breakouts, you know, we're looking for a break, and then if it rallies the next day back above, excuse me, back above that support, you might want to be a buyer with a stop below. And since then, it hasn't really looked back, and it does look like it's broken the back of this downtrend that had been in place since July. So it looks like we've broken a 2-month downtrend in dollar yen. So that would make the immediate target, these old highs, up around 114. It's about 111.30 at the moment. So I think on dollar yen, from a shorter term time frame, the trend is nowhere near as drastic as the ones we're seeing in euro dollar and pound against the dollar. But any weakness, any decent weakness in dollar yen looks like a buying opportunity. The ideal setup will be another trip back down to 108 and a bounce and a stop below that breakout low. But I think you know, the fact it's rallied so strongly after that false breakout suggests there's still an appetite out there to be a buyer of the dollar against the Japanese yen. Right, let's have a little break from the old squiggles and let's take a look at our strategy thing for today. So this is where I'm going to do a little bit of scribbling. So I just need to flip the screen over. So we're going to talk about oscillators. I think when people start trading, I know I definitely made this mistake, but something I did was using oscillators to try and find the perfect system. You know, so I remember spending many months fiddling around with slow stochastics and RSIs and thinking there's a perfect system out there. The reality is there isn't a perfect system, and I'm not the biggest fan of having 1,000,001 oscillators on your chart, because I think you can end up not seeing the wood for the trees. And I think this is one reason why plenty of people lose, because they end up ignoring obvious things like trends and big levels and thinking the answer lies in a stochastic with Fibonacci numbers or something. And it doesn't, but that doesn't mean oscillators are completely useless. I think one of the uses, one of the better uses is this idea of divergence. So we'll jump back on the charts and see some examples in a sec. But it's basically, you know, we've got a market that's trending lower, and it looks something like that. Then underneath, we have our oscillator. And so for the purposes of this, we'll go with the RSI. So all oscillators are, and again, this is another reason why I think they can be overrated. All they do, they take this price data and they mangle it around a bit and show it in a different way. And it's normally just a mathematical formula applied to the price data. So RSI, relative strength index, a 10-day RSI will just look at, well, how strong is the market today compared to how strong it has been. Typically, a reading over 75%, the market is said to be overbought. A reading below 25%, the market is said to be oversold. So our oscillator, plotted on a chart like this, you know, might look something like that. Okay, so the market goes up, goes down, goes up, goes down, and that. So it goes from overbought to oversold, you know, following the swings in the market. But this whole idea of divergence is when this thing happens, and we're going to look at some real examples in a minute. So the market hits new lows for that particular trend, but our RSI starts making higher lows. So the RSI is diverging from what the price is doing. So this is known as bullish divergence. The flip side, if the market's going up, our RSI will typically be following the market up, going from overbought to oversold. But it's when we get that sort of thing, where the market has hit fresh highs for the trend, and but the RSI looks like it's losing interest. So that's bearish divergence. So this can be a warning that this trend could be running out of steam. This down here is a warning that the downtrend is running out of steam. And I think because it's not that common a signal, I would definitely give a lot more weight to a divergence signal on an oscillator rather than just a straightforward oversold. But enough sort of talk about the theory. Let's take a look at it in the real world. So let's go back. If we flip it back to, let's go to pound against the dollar and show you what I'm talking about. So let's see what we've got going on here to try and find what might be considered almost textbook examples. And you can never find lots of textbook examples, but I suppose probably the best example on the daily chart we've got to go to the end of last year. So the market, if you look at the market pound against the dollar, you know, hits a low 28th of December, pushes lower still into January. So the market is definitely continuing this weakness. But if you look on the RSI, you know, we hit a low there. Oh, I can't draw on the RSI, but you see we can hit a low there, but when the market's making fresh lows, our RSI has made a higher low. So this is bullish divergence, easy to spot in hindsight, obviously, but that's bullish divergence. That's a suggestion that maybe this weakness is running out of steam. We've got, if we jump across to here, it's not a perfect example, but in June of this year, where pound against the US dollar had been sliding off those May highs, so traded down to about 126.35, has a bit of a bump higher, and then trades a bit lower again down to 125.90. So it slips about 40 points below those old lows. So the market still going down, but our RSI is flat. Okay, so again, yes, the market is still going down, but it's maybe not going down at the same rate it was before. Okay, so that's our bullish divergence. Sorry. At the moment, we've got nothing going on. I don't think we've got the market's pushed to a high. The RSI has gone to a high. The market's pushed higher still, and the RSI has poked out to fresh highs. So we don't have anything that looks like bearish divergence. We've got to go back. Let me just pick it up on here just to show the example the other way. Look at what was going on here-ish, where the market from April through to May was pushed out to a high. RSI overbought, pushes out higher again. RSI is roughly the same level, pushes out higher again. The RSI has completely lost interest. Okay, so this was, again, in hindsight, particularly good bearish divergence setup. And I think the way to trade these, because by definition, you know, if we are trying to pick turning points in the market, if we're trading off a pattern like this, the market needs to turn around. You know, we can't be faffing about. I'd say, you know, an aggressive trade, if you see bearish divergence, well, then we're selling short here maybe after the RSI has turned down, and we've got a stop loss above the most recent highs. Because by definition, if the market blips higher, the pattern is invalid. Okay, and the same way down here, wherever it was, if we're buying after the RSI, it blipped up pretty quickly. But if it had taken out that previous low, you know, there was no point in staking things on the RSI divergence because the divergence clearly hadn't worked. So so I think it gives you good risk reward. There are patterns that don't happen very often, and it can give you a good risk reward because you can have a tight stop, and if you do catch, you know, a major turning point in the market, you've got the potential for lots of profit. So this is a 10-day RSI that I've got on my chart. Someone asked what period it is. Let's take a look on the hourlies. Because of the moves we've seen in pound US dollar, it's a little bit scrappier. You could, I think it's stretching it a bit to call this bullish divergence. This was, when was that? That was interest rate day, last Thursday. So the market hits a low, pushes lower again when the announcement comes out, but the RSI is going up. But I think that happened so quickly, you'd have been really fortunate to catch that. Let's see if we can get any better examples. There's nothing actually that obvious on the hourlies, I don't think, going on. But let's take a look at a different market. Let's take a look at euro dollar and see what we can spot. It's not okay. There's not a bad example here. Bullish divergence from the 17th. When was that? 19th, 18th. Oh, last week. Sorry, from last week. This time last week. So the euro dollar hits a low, has a bit of a rally, pushes lower again, but then pushes lower again. So we have almost a triple bullish divergence here, where the market spiked low, but but the RSI was already trending higher. Actually, at the moment, we do have bearish divergence on the RSI. If we're looking at, this is on the hourly chart. So let's take a look. So what I'm talking about, the euro dollar pushing higher, bang, bang, bang. RSI is trending lower. So again, the aggressive trade here, if we were going to trade purely off the off the bearish divergence, we'd be a seller now, wherever it is, 120 and a bit, 120.02, with a stop loss above that high. So that high is 120.22. Let's say we put a stop in at 120.35. So we're going short now with a 30-point stop loss. And if we do, if we do see the end of this trend, we do get a half decent sell-off. Okay, but that's a bit of bearish divergence, I think, building up. So that's the idea behind it. You don't, like I say, you don't see it that often. So I think when it does happen, it is worthy of maybe a little bit of attention just to see what's going on with it. So that's it. We'll keep the RSIs on there just in case it pops up on any other interesting markets. Of course, the other big news over the last week is there's been the same news as usual for US stock markets. US stock markets hitting record highs. So let's start off by looking at the S&P 500. I'll do my usual and log in to another broker to see which way people are positioned on the S&P 500, and I will bet that most retail traders are short the S&P 500, and they're short because it's going up and it's at record highs. Let me have a look. What's the percentage breakdown? 80%. Here we go. So with another broker, out of all the positions open on the S&P 500, 80% of them are shorts. And of course, this is a market that whenever it's gone down, it doesn't stay down for very long. And it's only, I think, was it yesterday, maybe the day before, we pushed out to fresh all-time highs. It looks like in the overnight market, we've nudged out to maybe another fresh all-time high. Actually, no, very briefly. But this trend, I think I just messed my chart up. There we go. That's it. Daily chart. So this trend goes all the way back, or this bit of the trend anyway, goes all the way back to the election, the US election last year. So where were we last year? Just before the election, November last year, the market was 2132, 2130, let's say. It's currently above 2500, so that's what, 370 points, 15% and a bit more since the election last year. So if we pick up on our trend, it looks like we had a bit of a wobble through the trend, but no real major supports broken, and our trend now looks something like that. So for me, for US stock markets, any weakness continues to be a buying opportunity. Whenever the market sells off, it does sell off really heavily. We get some really sharp sell-offs, but look just how happy investors are to step in and buy it. And I think it's a really easy level to watch on the S&P, and I think the big level is 2400. It's that level there, near enough. It was a problem on the way up during March, couldn't get through it. May had to go through it. Then it broke. Look how many times it supported the market. When we had the initial sort of tension between North Korea and the USA, the market sold off, but again, we saw buyers step in at 2400. So it's a long way away from that level at the moment. But it would only take a 5% fall to bring the S&P back to that 2400 level. But it's a market that is clearly still strong. Maybe we'll get some volatility tonight off the back of the Federal Reserve, the interest rate announcement. But I hope so, because it's pretty boring when it's like this. Could do with a little bit more volatility, a few more days, when at least it has a half decent sell-off, so we can load up for the next leg higher. And going back to the whole bullish, bearish divergence thing, we've got some going on here. So if we look at what was happening August, so if we go from here to here, so the S&P was selling off, and I think that was North Korea inspired. So S&P is selling off. But look at what our RSI is doing. We're on the same RSI, 10-day RSI. S&P hits a low, rallies, but dumps, pushes lower. The RSI, again, this is bullish divergence, okay, where the RSI market hits a low, but the RSI doesn't follow it. I suppose we had a bit of bearish divergence up here, but it took a while to pan out. But you can see, again, this idea of bullish divergence played out on the last major sell-off we had on the S&P. The market is overbought again. But just look at how it was back here, back in February. Look how it was overbought then, and the market just carried on powering higher. So I think it's dangerous in a strong trending market like we obviously do have with US stock markets at the moment. I think it'd be dangerous to trade against this trend, and any weakness looks like a buying opportunity. So let's see what happens later on today. This is an hourly chart, just to give you an idea of just the lack of volatility in recent days. Look how tight that range is. You know, it's gone from 2,500 to not even 2,510 over the last few days. So 10 S&P points, slightly more than 100 Dow points. That's been a range for the last few days. So again, if you're going to short-term trade it, if we had a sell-off tonight on the interest rate decision, the first level I'd be watching it is 2,500. You know, if we push down to here and see the buyers come back in, stop below, see what happens next. And then if we do break that, 2490 is the next obvious level. But clearly, I'd suggest the bias would be to be a buyer on weakness still for the S&P. If we look at the Dow, it's going to be a similar story. We'll just look at that very quickly, of course. But let's have a look on the dailies. You know, clearly it's moving the same way. The old barrier was 22,170. Bang, it's gone through that. These US markets are still incredibly strong. Let's have a look at the German market. Then we'll have a look at commodities. We'll have a look at gold and oil. Once again, I should pay more attention to this bullish divergence thing. I mean, I might have been stopped out there, but it's a similar thing. So this is daily charts. Again, just sticking to the dailies for now. So the market goes low, pushes lower still, so low, and then low into whenever that was, August, middle of August. The RSI makes a higher low. And this has been, I think we've picked up on this before, what a big level, whatever it is, that sort of 11,800 area had been for the German 30. You know, it's been a bit of support on the way up, and it finally looks to have shaken off this downtrend that had been in place since June. So again, it does look like after quite a few months of just getting clobbered, it looks like the German market has turned the corner. So, you know, again, I'd suggest any weakness looks like a buying opportunity, but you can see just how quiet the last few days have been in terms of volatility. So that's it. So in summary, everything's going up. Pound's going up, euro's going up. Stock markets, you know, US stock markets incredibly strong. Let's take a look at some of the commodities. Let's start off by looking at oil. I thought it was interesting. I haven't traded it, but I think it was an interesting level. I think it was earlier this morning to watch an oil. Or was it yesterday? What am I talking about? Yesterday, last night it was. I think this sort of $49.50 a barrel. This is the November contract we're looking at, but sort of 49.50. You know, the market had a bit of a pause on the way up, pushed up to near 51, came back to it September the 18th, bounced up another $1, came back to it again last night, and it's bounced up again off it again. So I think that's really clearly a big level to watch. Later this afternoon, we've got the latest oil inventory figures, so that can cause some volatility in the oil market. But let's take a look at the daily picture. I've not traded this one for a few weeks now, but I think it's interesting where we are, where we're back up to the highs from July. Let me just pick up on a couple of things. We've got this trend off the February highs, maybe looking something like that. Okay, so we've got that trend line coming in that's being tested on oil. We've got the old highs from here. What's that? 50.51. So $50.51. We've got the old highs here where it's really having a go. So I think it's interesting. We've got, you know, some big levels to watch in oil. We've got this whole resistance area to the previous highs from back in May. So $50.50 through to $52.20. So you could argue if you wanted to go short oil anywhere, this looks like a pretty good place with a stop loss somewhere above this old high up here. You know, it's struggled with these highs, but I think if we can crack 52 properly, then we start to gear up for a run back up to the highs set at the beginning of the year, just up above $56 a barrel. So I think it's an interesting one, oil. But I suppose, I mean, probably the sensible trade is to be short, I would say. Famous last words, because you could argue that trend is still down. So the sensible trade on oil is maybe to be short. There's not the prettiest set of divergence here because it's gone a bit too far, I think, between the peaks. But the RSI is approaching overbought. So let's see what happens. But I think it's going to be interesting to see how it performs in this sort of area. And the final one is gold. I think we've seen some real strength in gold, clearly helped by the ongoing weakness in the US dollar and the tensions on the world stage, you know. So if we take a look, I think I've just messed the chart up. What's happened here? Because I've been bullish on gold all this year, and it's sort of stuttered and struggled to get going up until about a couple of months ago. So I think, you know, for me, the big picture view on gold is, okay, it's been 6 years since we saw those highs for gold up at $1,900, and for most of the years since then, the price of gold has sold off. But it does look as if that the trend that had been in place since August 2013 was broken last year. We saw the market rally and really stage a strong recovery, you know, back up to the 2014 highs. Then it got clobbered towards the end of last year, but we're back again. So I think, you know, for the longer term gold trader or investor, you know, the big levels to watch are last year's highs up around 1375. And I think if we can crack 1375, it sets up the potential for a much stronger recovery. Let's take a look on the dailies though to look at some levels to watch. There's an argument, I suppose, based on the trend to be a buyer now. If we looked at the trend off the December low, so about 10 months ago, so there's our trend there. If we flip it over and look at the shorter term market, shorter term trend, sorry. Oh, wrong one. Then it looks something like this. So hang on, there we go. So the move that we've seen off those highs, just shy of 1360, we've sold off for a couple of weeks or so, but we're finding support, and 1300 has been a big level for the price of gold. You know, it was the highs near enough. Hang on, if I got the right line. It was the highs near enough back here and here. And support here. So an aggressive trade would be to be a buyer wherever it is now, 1315 near enough, with a stop loss underneath those 1300 lows. But I think any weakness, any significant weakness in gold looks like a buying opportunity. Let's have a quick look on the hourlies and see how it looks. There we go. We can see, and actually that does, I suppose, does that help the argument? I suppose it's not quite broken out of that downtrend on the hourlies. And if we're looking at the RSI and the hourlies, it looks a little bit overbought. So maybe a bit more patience is needed. Maybe we'll get another bite of the cherry down here if we see a sell-off in gold. But you can see, I think on the hourlies, it's even more clear what a big level that sort of 1300 one has been. So I think gold's an interesting one to watch. But for me, that trend is still up. We'll start wrapping things up there. As usual, we'll do this all again next week. I think we're in for a quiet afternoon ahead of the what's it, the US interest rate decision this evening. Maybe that will inject some volatility. Maybe if they really rein in this economic stimulus, you know, we'll see something of a sell-off in stock markets. But at the moment, it's a braver man than me that bets against the US stock markets, because it just goes sideways for a bit, then blasts out to fresh all-time highs and rinse and repeat. But let's see what happens later on this evening when we have that interest rate decision. But I'll start wrapping things up there. I hope you found the divergence thing useful. I think it's a better way, I think, of using things like RSIs and stochastics rather than just looking at overbought, oversold. You know, looking for where the market's doing one thing, but our oscillator is doing something else. We'll do it all again next week with a different strategy. We'll see what the markets are. But I'll wrap things up there. I hope you have a good afternoon, and see you all again next week.